For 5,000 years, it was the final answer to panic. When empires fell, currencies hyperinflated, and banks failed, humanity's last resort was one asset: gold. It was the ultimate fear hedge. But what happens when the hedge against collapses? We found out in 72 hours. $10 trillion in perceived global wealth, the bedrock of central bank reserves, pension fund insurance, and family legacies, didn't slowly sell off. It vaporized. Here are the numbers that changed everything. Between Monday open and Thursday close, the spot price of gold imploded from $2,400 to $650 per ounce, a 31% free fall. The SPDR Gold Shares ETF, GLD, saw a record-shattering 18.7 billion single-day outflow as the paper market disintegrated. But the real panic signal was in the physical market. The premium for a physical bar over the paper price exploded to over 25%, proving a complete, catastrophic breakdown of trust in the market's core pricing mechanism. The paper promise and the physical metal divorced in a day. This wasn't a bubble popping. This was the floor of the financial bunker, giving way. The crash revealed a terrifying inverted truth. In a modern liquidity-starved panic, the supposed safe haven can become the primary source of liquidity to be slaughtered. It wasn't being bought as a refuge. Its massive leveraged paper representation was being sold to cover losses everywhere else. So, the core world-changing question is this: how does the asset designed to survive the apocalypse become the epicenter of the apocalypse itself? The answer isn't in a Swiss vault or a mine. It's in a hidden, multi-trillion-dollar game of financial Jenga, played in the shadows by central banks and macro hedge funds, using gold not as money, but as the ultimate collateral token. And the first tremor that toppled this tower wasn't in the gold pits. It was in a market everyone thought was disconnected: the market for Japanese government bonds. Let me show you the trigger. The collapse began not with gold, but with the unthinkable failure of the one market thought to be fail-proof: the U.S. Treasury market. At 1 p.m. Eastern, the results of a $24 billion 30-year Treasury auction flashed across screens. The tail, the gap between the average and highest yield accepted, was a staggering 7.5 basis points. This wasn't just weak demand, it was a failure. Primary dealers were force-fed billions of bonds they couldn't sell. Simultaneously, Tokyo announced a $220 billion asset liquidation by Japan, its largest life insurer, to stem catastrophic yen-fueled losses. The 10-year Treasury yield spiked 50 basis points in 90 minutes. The global anchor of finance was adrift. This violent repricing was the detonator. It triggered margin calls across the $2 trillion global risk parity and a volatility targeting fund complex. Their models, designed for stability, were hit by the impossible: simultaneous explosive losses in both bonds and stocks. Their mandates demanded immediate, forced deleveraging. They had to raise cash, and they had to do it within the hour. Here was their brutal choice. Their portfolios held only 3 liquid assets: Treasuries, in free fall and illiquid; blue-chip stocks, in a circuit breaker crash; and gold ETF shares and futures, still calm, still deep. With the first 2 markets in seizure, the automated sell orders flooded into gold. Not out of fear about gold, but because it was the last large, uncorrelated pool of liquidity their algorithms could access. The data screamed the warning. The CBOE 10-year Treasury Note Volatility Index, TIVIX, spiked to 120, an all-time high indicating pure panic. Meanwhile, the Gold Volatility Index, GVZ, sat at a sleepy 18. This divergence was the flashing red signal. The calm in gold wasn't strength, it was the eye of the hurricane, a deadly illusion of stability that was about to be obliterated by a tidal wave of mechanical selling. The documented perception that gold is uncorrelated, a diversifier, was obliterated by the verified reality of a systemic margin call. When leverage is called globally, all assets are correlated by one thing: the desperate need for dollars, not safety. The first massive sell orders hit the electronic exchanges at 2:15 p.m. They landed not on a solid floor of physical demand, but on a paper-thin layer of algorithmic traders and leveraged derivatives that amplified the fall. Let me show you the hall of mirrors they crashed into. The crash revealed a secret hidden in plain sight. The modern gold market is not a commodity market. It's a fractional reserve banking system built on promises, and its leverage was about to implode. Here is the staggering scale of the deception. All the gold ever mined in human history is worth roughly $13 trillion. The actual available physical investment market, bars and coins you can hold, is a tiny fraction of that. Yet the paper gold market, the ETFs, the futures on COMEX, the unallocated accounts in London, and the bank swaps represents derivative claims on over $10 trillion worth of gold. The paper claims nearly equal all the gold that exists. This is the pyramid. Zoom in on the heart of the system, the London unallocated market. In the LBMA's over-the-counter trade, over 95% of transactions are for unallocated gold, an unsecured IOU, a promise to deliver metal. Banks trade these promises with a leverage ratio that can exceed 100 to 1. When confidence holds, it's fluid. When it breaks, it's a claim on metal that simply does not exist in deliverable form. Now, watch the ETF arbitrage engine fail. ETFs, like GLD, are meant to be backed by bars. Their price is kept in line by authorized participants, APs, big banks, who swap metal for shares to pocket tiny arbitrage profits. But when the Treasury market seized, their dollar funding evaporated. They stopped arbitraging. Instantly, the ETF price decoupled, trading at a 20% discount to the spot price it was supposed to track. This wasn't a pricing error, it was a system failure. The discount triggered a new, vicious wave of panic selling in the ETF itself, which forced more selling in the futures to hedge, crushing the spot price further. The critical point is this. The initial wave of fund selling didn't meet physical buyers. It hit a network of leveraged speculators and underfunded market makers. Their forced liquidation became the second, third, and fourth wave of selling. The documented belief that owning GLD is owning gold wabastus was vaporized by the verified reality of a broken chain of financial promises. With the paper market collapsing, the logical next step would be a mad rush to claim the physical metal, but the system had a final devastating trapdoor already primed to swing open. Let me show you the run on the vaults. The final devastating phase of the crash was a brutal lesson in financial physics. Price and liquidity are not the same thing. As the paper price cratered, the desperate scramble was for the metal itself. And that's when the system's trapdoor swung open. The first signal was the physical premium explosion. Then came the settlement failure. At 4:30 p.m., ahead of the monthly futures expiry, two major clearing banks issued notices, citing unprecedented market dislocation and inability to source deliverable metal. They would settle contracts in cash only. This was the layman moment for gold. It was the official admission that the pyramid of promises, the unallocated accounts, the futures, the swaps, could not be honored with the actual asset. The core contract of the market was broken. This triggered a retail stampede. Headlines of "banks can't deliver gold" sent queues around blocks at coin shops. They sold out in hours. But this is the cruel irony. The entire North American retail coin and bar market is worth about $5 billion. It is a rounding error, a symptom of the fear, but utterly powerless to absorb the trillions in paper claims vaporizing. The run was real, but irrelevant to the scale of the collapse. Even traditional holders turned into sellers. Central banks, needing dollars to defend their collapsing currencies in the global storm, activated gold swap lines with the BIS or sold outright. These strategic reserves, meant to be a bedrock, became a new source of forced supply into a market with no structural bids. This led to the ultimate terror, the no-bid moment. For 47 minutes, between algorithmic cascades, the world's most ancient store value had no reliable price. Electronic exchanges halted. The LBMA gold price auction failed to fix. The market was practically closed. $10 trillion in perceived wealth was in price discovery limbo. Frame this catalyst correctly. The crash wasn't about the value of gold. It was about the horrific discovery that the financial system built on top of gold had rendered gold itself illiquid at the precise moment the entire world needed liquidity most. The contagion was now total. If the 5,000-year-old safe haven could fail, what asset was truly safe? The answer, in a stunning and paradoxical reversal, became the very cause of the panic, the US dollar. The scramble was no longer for safety, but for survival, and it entered its most dangerous phase. Let me show you the monster that was born from this chaos. The collapse of gold triggered a final catastrophic phase, a mad global scramble for the only liability that still functioned as money, the US dollar. In the ultimate paradox, the flight from a crashing asset class became a violent rush into the very currency whose weakness gold was supposed to hedge. The DXY dollar index soared 8% in 48 hours, not on strength, but on sheer desperate demand for settlement cash. This extreme cash is king panic triggered the next wave of forced selling. Everything had to be sold to get dollars. The contagion map became apocalyptic. First, emerging market currencies imploded. Nations with dollar-denominated debt saw their borrowing costs explode. Their central banks, desperate for greenbacks, conducted fire sales of their U.S. Treasury reserves. This dumped more bonds into a seized market, pushing yields violently higher and worsening the very Treasury crisis that started the domino chain. Second, the commodity death spiral ignited. Major trading houses, which use gold and oil futures as loan collateral, faced insurmountable margin calls. To raise cash, they dumped crude, copper, and wheat contracts in staggering volumes. Real asset prices, supposed inflation hedges, crashed in unison with financial assets. Third, the pension fund time bomb detonated. Conservative funds, with safe allocations to gold ETFs and long-dated bonds, saw their solvency ratios evaporate overnight. To meet regulatory capital requirements, they were forced to sell blue-chip equities into a market with no buyers, accelerating the stock market crash. The $10 trillion Vanishing Act was now fully realized. It wasn't just gold's lost market cap. It was the combined destruction in gold miners, commodity ETFs, emerging market sovereign debt, and the pension fund bond portfolios being liquidated to survive. A financial neutron shockwave, all tracing its origin to the initial fatal seizure in the gold liquidity machine. This obliterated the documented crisis model where gold rallies. The verified historical precedent is March 2020, when gold initially crashed 12% in the dollar dash before recovering. This was that event on steroids, where the rush for cash completely overwhelmed every other historical narrative in hedge. As the entire system reached the electrified brink, the pressure focused on the only entity with the power to create the demanded dollars out of thin air, the Federal Reserve. But its entire crisis playbook was written for bank runs and bond market freezes. It had no page for a gold market failure. Let me show you their unprecedented, desperate response. As the system bled, all eyes turned to the lender of last resort. But the Federal Reserve found itself trapped, its legendary crisis playbook rendered useless. Its tools are engineered for bank runs and bond market seizures, not for the failure of a global, decentralized, over-the-counter commodity money market. The traditional arsenal was pointless. Cut interest rates? Impossible. Rates were already elevated to fight inflation. Cutting amid a currency panic would crater the dollar, intensifying the global funding crisis it was trying to solve. Quantitative easing, QE, buying treasuries might stabilize bonds, but it would do nothing for the trillion-dollar rupture in gold derivatives, ETF arbitrage, and unallocated London accounts. It was like using a fire hose on a structural collapse. The unthinkable option emerged. In desperate backroom calls, a radical idea surfaced. Should the Fed open gold-backed swap lines? This would mean accepting physical gold as collateral from foreign central banks to provide them with dollar liquidity. It would be a historic, de facto return to a gold standard, validating the very asset whose market had just imploded. A stunning admission of the dollar's fragility, the political abyss. Any direct move to save gold would ignite a political firestorm. It would be denounced as a bailout for hedge funds, foreign sovereigns, and the ultra-wealthy. The Fed's remaining credibility and independence would be incinerated. Yet, inaction risked a complete freeze in the collateral chains underpinning the global shadow banking system, triggering something worse than 2008. The likely Kafkaesque response. What unfolded was a masterclass in opaque crisis management. A cryptic joint statement from the Fed, ECB, and BOJ was released. We are closely monitoring conditions in commodity and derivative markets and stand ready to provide liquidity as needed to maintain the smooth functioning of the financial system. Translation. They would not save the gold market. They would provide backdoor liquidity to the major banks now drowning in losses from that market, preventing their failure. An indirect, messy, and inefficient bailout of the symptom, not the cause. The critical, exposed failure. The crash laid bare a fatal flaw in the global architecture. Gold, while officially demonetized, remains a critical, unregulated node in the shadow banking network. It is a Tier 1 asset on bank balance sheets, prime collateral for derivatives, and a core reserve asset. Its collapse blew a multi-trillion-dollar hole in the world AS balance sheet that no central bank had a mandate, mechanism, or willingness to directly fill. This shattered the documented, unquestioning faith in the central bank put, the belief that they could and would backstop any systemic asset. The verified reality was a stark lack of tools for a non-sovereign global commodity money. The immediate fires were contained, not extinguished. The trading halts were lifted, the most extreme margin calls were met. But the aftermath left a permanent scar on the financial psyche and delivered a brutal masterclass lesson in the true hierarchy of safety when the digital scaffolding falls away. Let me show you the new, terrifying pecking order. The smoke cleared on a financial landscape permanently altered. The 72-hour crash didn't just destroy wealth, it rewrote the sacred hierarchy of asset safety, exposing brutal new truths. 1. The dollar's Pyrrhic victory. The dollar stood alone, but changed. It wasn't trusted, it was necessary. Its surge was not a vote of confidence, but a testament to its monopoly as the only operational settlement medium in a bankrupt system. Its value became higher, but more volatile and political, a fiat weapon recognized by all. 2. Gold's fractured identity. A permanent, two-tiered reality emerged. Physical gold, direct, vaulted, became the ultimate unencumbered asset for sovereigns and the ultra-wealthy, a private, off-grid money immune to system failure. Its premium became structural. Paper gold, ETFs, futures, unallocated, was reclassified as a toxic financial derivative, a broken money product. It would forever trade at a wide, perpetual discount to physical, its monetary narrative destroyed by its own failure. 3. The rise of pure collateral. In the rubble, only two assets held their function: short-term U.S. Treasury bills, T-bills, the simplest, most direct claim on the taxing power of the state, with no complex chain. They became the benchmark clean collateral. In-ground energy and critical commodities, tangible, usable, and with no massive derivative overhang, their value was in use, not financial promise. 4. The regulatory onslaught that makes it worse. Global regulators, aiming to prevent a repeat, would crush the paper gold market. Margin requirements would skyrocket, reporting would be draconian, and leverage would be slashed. In trying to make it safe, they would suffocate its liquidity, ensuring it could never again act as the large liquid pool it once was. The long-term psychological impact. The crash did the unthinkable. It severed the 5,000-year psychological link between humanity and gold as monetary armor. It was demoted from a safe haven to just another volatile commodity. The global search for a stable store of value was reset to zero, creating a vacuum of unimaginable consequence. This contrasts with the documented expectation of a post-crash return to normal, where gold always recovers. The verified outcome is a paradigm shift, where the asset's core narrative is irreparably broken. This scenario isn't fantasy. It is the extreme stress test the modern gold market has never faced, but is uniquely vulnerable to. The March 2020 dash for cash, where gold fell 12% amid panic, was merely a warning shot across the bow. The structural flaws it revealed have only grown larger. To see how close we are, you only need to look at one real-time metric. Let me show you the fuse that's already burning. Beyond the numbers, the crash would perform a brutal autopsy on modern finance, dissecting and exposing three core illusions that investors treat as laws of nature. Illusion 1. Liquidity is a constant. We believe markets are always liquid, that we can exit at the posted price. This is a function of calm. In a true storm, liquidity doesn't gradually decline. It vanishes instantly, and it does so first from the most complex, leveraged markets. The paper gold market, with its layers of derivatives, swaps, and algorithmic trading, was the paragon of deep liquidity. In the crisis, that liquidity was revealed as phantom depth, a hall of mirrors that collapsed into a single desperate and impossible sell order. Liquidity is not a property of the asset. It's a condition of the market, and the condition changed in minutes. Illusion 2. Safe haven means uncorrelated. We are taught that gold's safety lies in its negative correlation to stocks and bonds. This is a fair weather fact. In a systemic, balance sheet crisis, all correlations converge to one. The only safe haven is not the asset with the longest history, but the asset required to meet immediate dollar-denominated liabilities, cash. When margin calls hit en masse, gold's 5,000-year history is irrelevant. Its role as a leveraged financial asset makes it a primary source of funding, not a refuge. Its safety was conditional on the system not needing it to be sold. Illusion 3. ETFs are the asset. This is the most pervasive and dangerous belief. Owning GLD is not owning gold. It is owning a derivative claim on gold dependent on a fragile, profit-driven arbitrage mechanism run by a handful of banks. When that mechanism broke, when the authorized participants fled, the ETF decoupled. Shareholders didn't own metal. They owned a broken financial instrument trading at a catastrophic discount to its supposed underlying asset. The ETF was a conduit for the panic, not a shelter from it. As J.M. Keynes famously observed, markets can remain irrational longer than you can remain solvent. The gold crash is the ultimate expression of this, the irrational, catastrophic failure of the supposedly rational safe haven. These illusions are not theoretical. They are woven into the very fabric of today's gold market. Their potential unraveling is not a distant black swan, but a clear and present danger visible in the market's own real-time structure. Let me show you the single glaring metric that proves the fuse is already lit. This scenario is not science fiction. We have already seen the trailer. March 2020 was the live fire stress test, and the gold market nearly failed. Recall the dash for cash. As the pandemic panic hit, gold, the supposed safe haven, crashed 12% alongside the S&P 500. The physical premium for bars exploded. The arbitrage linking the London, LBMA, and New York COMEX markets broke, with the spread blowing out to levels never before seen. The system was seizing. The Federal Reserve was forced to take emergency action, opening unlimited dollar swap lines with foreign central banks, specifically to prevent them from having to dump gold or failing on deliveries. As the Bank for International Settlements later noted, this was crucial to ease strains in global gold markets. It was a full-scale dress rehearsal for systemic collapse. Why the next time, 2025 plus, is infinitely more dangerous. Higher systemic leverage. The post-2020 era has seen a massive influx into complex leveraged notes and derivatives linked to gold, seeking yield in a higher rate world. The paper pyramid is taller and shakier. The higher rate trap. With interest rates structurally higher, the cost of financing leverage positions is immense. Margin calls are larger, faster, and more devastating. Geopolitical fragmentation. In a crisis now, would the Fed seamlessly coordinate with all major central banks, or would strategic competition hinder the swap lines that saved the day in 2220? Concentrated, fragile ETFs. The top 3 gold ETFs now represent a $100+ billion monolithic claim on liquidity. They are not a diversified market, they are a single point of failure. The Catalyst watch list is live, a Japanese government bond market accident forcing their mega banks to liquidate global assets. The collapse of a major commodity trading house like Trafigura or Glencore, whose gold books are entangled in complex collateral chains. A disruptive, uncoordinated central bank selling program to raise dollars in a currency war. The critical difference, in 2020, the core problem was a global dollar shortage. The Fed's solution, printing trillions, worked. In a true gold market collapse, the problem is a failure of trust in a specific asset class and its derivative chain. Printing dollars cannot fix broken promises to deliver physical metal. It addresses the wrong failure. This shatters the documented view of March 2020 as a weird anomaly. The verified evidence shows it was a warning shot that revealed critical, unaddressed vulnerabilities in the heart of the safe haven. Those vulnerabilities have only grown. The purpose of this analysis isn't to predict doomsday. It's to provide a map of the minefield. For anyone holding gold as a crisis hedge, understanding the real structural risks is the only way to make the hedge work. Let me show you what a truly resilient position looks like. The $10 trillion crash scenario is not merely a shock story. It is the ultimate lesson in counterparty risk and liquidity transformation. The single most important takeaway is this. The safest asset in the world is worthless if you cannot access its value in a crisis, or if your ownership is merely a claim on a bankrupt intermediary. Your financial strategy must now pass the post-gold crash safety audit. Here's the checklist. Direct ownership or bust. If it's gold, it must be physical, allocated, and in your direct custody, or in a non-bank vault with your name on the bar. ETFs, futures, and unallocated accounts are bets on financial engineering, not on the metal. They're the point of failure. Liquidity trumps history. In a true crisis, liquidity is defined by one question. What will your immediate counterparty accept to settle a debt? The answer is almost always cash. Own the simplest form, short-dated, direct government obligations, T-bills. They are the cleanest claim on the state's taxing power. Diversify across systems. Own assets that survive the failure of any single system. This means a blend of physical cash, physical bullion outside banking, T-bills, and productive real assets. Your safety net must have multiple independent anchor points. Conduct the HALT test, stress test every holding. If the primary exchange or ETF for this asset halts trading for 1 week, am I financially ruined? If the answer is yes, you own a derivative, not a foundational asset. The Bank for International Settlements' own 2020 analysis concluded the gold disruption highlighted the importance of considering the interaction between market liquidity and funding liquidity. Translation: when the entire system needs cash at once, even gold isn't gold. Your call to action is immediate. Audit your safe holdings. Read the prospectus of your gold ETF. Understand the lethal difference between allocated and unallocated bank accounts. In the next crisis, the winners won't be those who owned the right asset on paper, but those who owned the right form of the right asset. The final verified insight: gold didn't lose its value over 5,000 years. The financial system built around it simply proved that in the digital age, the most valuable thing is not what you own, but the unbreakable, direct, and unambiguous chain of title that proves you own it.